One handle, one fingerprint. If you see this same format somewhere else and the next step is a DM asking for money, wallet addresses, VIP access, or signals, that's a scam. I don't sell anything, ever. Protect yourself. Now drop deficit in the comments if you're actually listening, because RBC just said the quiet part out loud, and it's the kind of line that sounds like hype until you realize it's coming from a major bank looking at supply math, inventories, and the one thing paper markets can't fake forever: physical tightness. Here's the sentence you need to hear twice. RBC says silver is entering its 8th deficit year, with inventories at an all-time low and investment demand showing no signs of abating. 8th deficit year, all-time low inventories, investment demand not cooling. That's not a bullish chart. That's a market that has been running below replacement for so long that the cushion is gone. And when the cushion is gone, price stops being a suggestion and becomes the rationing mechanism. Now, let's talk about why RBC uses language that basically implies the squeeze hasn't even started. Because most people think squeeze means a viral hashtag. In real markets, squeeze means something colder. It means the system discovers that supply isn't elastic. It means the price has to rise not to reward bulls, but to punish indecision. It means the market has to shake metal loose from hands that don't want to sell. That's what you're watching build. And RBC's analyst Marina Calero didn't just talk vibes, she put a number on the deficit. RBC says the silver market closed 2025 with a 242 million ounces deficit, and they expect it to remain undersupplied in 2026, 242 million ounces. That number matters because it tells you this isn't a one-off shock. It's structural. And structural deficits don't disappear because futures traders decide to sell on Monday morning. Structural deficits disappear in only two ways: either supply surges or demand breaks. So which one does RBC think is more likely in the near term? They basically say, don't bet on supply saving you. RBC says even if higher prices trigger some response, relief looks limited. They estimate secondary supply plus weaker jewelry and silverware demand might ease the deficit by about 50 million ounces. But that still wouldn't close the gap. Read that carefully. Even the relief scenario still leaves a shortage. Then RBC explains why mine supply won't just ramp up and fix this quickly, permitting hurdles, aging assets, and limited new discoveries. That's the part people don't want to internalize because it breaks the comforting fantasy that commodities behave like a light switch. Price up does not automatically mean supply up, especially not fast. And that's why the squeeze hasn't started isn't a meme. It's the logical conclusion of a market where the deficit persists and the supply response is slow. Now here's where your retention kicks in, because I'm going to connect the supply math to the one force that turns a tight market into an explosive market: investment demand. RBC says macro conditions should keep investment demand firm, and they list the right macro ingredients as a weaker dollar, demand for real assets, and easier monetary policy. That sentence is everything, because when a market is in deficit, the question is never, is it tight? The question is, does demand back off? Or does demand accelerate? If investment demand stays firm while supply is constrained, the market doesn't rebalance. It tightens, and when it tightens long enough, it changes behavior. People stop selling dips. They start hoarding. That's when squeeze psychology begins, not at the top. At the moment, sellers quietly disappear. Now, I want you to notice something else RBC did that makes this note more credible than the average silver hype thread. They gave you a near-term bullish framework and a medium-term risk warning. This is how real analysts talk when they're not trying to farm clicks. RBC sees the gold-silver ratio holding around 60-65x over the next couple of years as tight physical conditions persist. That's important because it quietly tells you something. RBC is not betting on an immediate ratio collapse to 15-1 fairy tale. They're saying tightness can persist even without silver becoming the runaway lead metal tomorrow. That's nuance, and nuance is what keeps you from getting emotionally wrecked. But then RBC turns cautious over the medium term for a reason that most silver bulls hate talking about: industrial demand destruction, especially in solar. This is the tension inside silver that makes it so violent. Silver is a precious metal, but it's also an industrial input. RBC says industrial demand was about 60% of total silver consumption in 2025. So if 60% of your demand base is industrial, you can't ignore what happens when price gets too high. Because when price gets too high, engineers don't argue on Twitter. They substitute, they thrift, they redesign. And RBC says exactly that. Silver now accounts for roughly 30% of average solar cell costs, and that's driving accelerated thrifting and substitution efforts. That line is a warning label. because it tells you what happens next if prices stay extreme. The higher silver goes, the harder industry tries to escape. And RBC goes even more specific. They say solar accounts for 17% of total demand, around 190 million ounces in 2025, and they warn that a silver-free solar technology could be the final cure to high prices. So RBC's full map is basically near-term, tight physical conditions, plus persistent deficits, plus supportive macro how squeeze can persist. Medium-term, beware demand destruction and substitution, especially in solar. That's the adult version of the silver story. Now here's the part where we switch from analysis to why this matters to you right now. Because your audience doesn't click for a research note. They click because they want to know one thing. Is this move real or is it hype? And RBC's note gives you the cleanest answer you'll get from an institution. If the market is entering its 8th deficit year and inventories are already at all-time lows, then the physical market is unlikely to rebalance quickly. Translation: if you're waiting for cheap silver to magically come back because the paper market says so, you might be waiting in the wrong decade. But, and this is the part that keeps us honest, RBC also tells you what could cap silver later: industrial substitution. So how do you hold both truths at the same time without becoming either a doom addict or a hype addict? You use the only framework that works in real markets: time horizons, near term, deficits, plus low inventories, plus investment demand; medium term, substitution risk grows as prices stay high. Now let me give you the squeeze hasn't started explanation in one clean mental image. Imagine the silver market like a reservoir. Deficits are the leak. 8 deficit years means the reservoir has been draining for a long time. All-time low inventories means the water level is already near the bottom. Now, investment demand is like turning the faucet on. If the faucet stays on because the macro ingredients are supportive, then the reservoir doesn't refill. It empties faster, and at some point the system stops behaving smoothly. It starts rationing. That's the squeeze. Not the first rally, the point where availability becomes the story. Now, RBC didn't stop at macro. They also talked equities, and this is a hidden clue about how advanced this cycle already is. RBC says silver equities remain attractively valued compared to the broader market, but they also warn many names are already pricing in bullish silver assumptions. Then they drop the kind of detail most people ignore. They say silver equities premium to gold producers is above historical average, and producers in their coverage are pricing in about $100 Oz, while royalties are pricing in about 144 Oz, above spot around 90 Oz. That matters because it tells you the equity market is already leaning into a bullish silver future. So if you're the kind of person who thinks nobody believes in silver, that's not entirely true. Parts of the market already believe enough to price it in. And that creates the next layer of squeeze psychology. If silver delivers the outcome the equities are pricing, the trade feels validated. If it stalls, those equities can get punished because expectations were front run. That's why RBC, despite the constructive near-term squeeze setup, says they ultimately favor gold producers over the medium term. That's not bearish silver. That's risk-reward math. Now, RBC also named their preferred picks inside the silver space. They highlighted Hochschild Mining and Kure Mining as top picks, with Wheaton Precious Metals and OR Royalties as preferred in the royalty space. Again, that's not hype. That's positioning. Now let's do what your competitor does best. Turn all of this into a clean, high-retention scenario map. 3 paths, no fairy tales. Path 1, the near-term squeeze persists. Deficits remain, inventories stay tight, investment demand stays firm under supportive macro conditions. In this path, price doesn't need a conspiracy. It needs time. Path 2, the squeeze persists but gets choppy. Prices rise, then volatility knocks people out, then prices rise again because the deficit doesn't vanish and the supply response stays slow. This is the most likely path in real commodities. Stair steps, not smooth ramps. Path 3, the medium-term cap starts forming. Solar thrifting accelerates, substitution grows, and the market begins to believe the cure could be technology, not new mines. In this path, silver can still be high, but the upside becomes more contested over time. Now here's the open loop you should hold, because it's the key to whether the squeeze starts in the way people mean it. If inventories are already at all-time lows and deficits keep stacking, what happens the first time investment demand doesn't just stay firm, it accelerates. Because that's when price stops being negotiated. That's when price becomes demanded. And demanded prices don't move politely. They gap, they run, they punish hesitation. Now the watch list, because if your audience wants anything, they want something to track that makes them feel in control. Here's your RBC-based watch list, simple and ruthless. And watch number 1, does new data continue to confirm undersupply into 2026? RBC expects it. If undersupply persists, the squeeze thesis stays alive. Watch number 2, do inventories stay tight? RBC says they're at an all-time low. Tight inventories make spikes sharper and dips scarier. Watch number 3. Do the macro ingredients remain supportive? Weak dollar, real asset demand, easier policy? RBC says those conditions support investment demand. If those ingredients stay present, investment demand can keep the bid alive. Watch number 4. Do you see solar substitution accelerating? RBC flags it as the medium-term risk and even frames silver-free solar tech as a potential final cure. If that narrative becomes real-world adoption, it can change the demand curve. Watch number 5. Are silver equities still pricing in $100, $144 silver while spot is around $90? RBC says they are. That tells you expectations are already high in parts of the market, which means reality has to keep delivering. Now I'm going to end this the way your train style demands. 3 takeaways, 1 cliffhanger, and a reminder. Takeaway 1. RBC says silver is heading into its 8th deficit year with all-time low inventories, and the physical market is unlikely to rebalance quickly. Takeaway 2. The deficit was huge, 242 MAs in 2025, and RBC expects silver to remain undersupplied in 2026, with only limited relief even if secondary supply rises and some demand weakens. Takeaway 3. The medium-term risk isn't paper games, it's engineering. Industrial substitution, especially in solar, where RBC says silver is 30% of solar cell costs and solar is 17% of total demand. And here's the cliffhanger. If silver is already in its 8th deficit year and inventories are already at the floor, how many more months of firm investment demand does it take before the market stops asking, what's the price, and starts asking, how soon can you deliver? That's when the squeeze starts in the way people will remember. This isn't financial advice. This is financial warfare education. Verify everything. Watch the data. And if you want me to keep mapping analyst notes like this as they drop deficit in the comments so I know you're following the mechanism, not just watching the fireworks.